What it means from a sort of an investor's perspective is that the role of the private sector is just set to increase.
3 billion. That's a return of £17 per pound invested. It's a phenomenal rate of return.
What we can expect going forward with those stimulus is some cautious growth in actual deal flow.
Significant development in the market, which got quite a bit of attention today earlier in the morning, is the co-investments and the direct investments in infrastructure. This is definitely something quite fashionable, and a lot of clients are asking numerous questions about this, so definitely.
When you start a new asset class as an institutional investor, you have to learn. And the easiest way to learn, two things: you want to learn and you want to diversify. And I think in order to do so, unless you start with a very, very large amount of capital, going the indirect route is probably the most prudent and efficient way to do it.
I also think a lot more money is being raised, more funds are being raised, more funds are being invested, and more LPs are committing to funds in the sector.
If you look at the spend that people have been making in the sector, in the last 5-year plan of India, the country spent close to about $400 billion in infrastructure. In the next 5-year plan, which is what we are currently in, it's going to spend about $1 trillion. And of this, more significantly, about between 1/3 to 50% is going to be coming from the private sector. So this is not a sector that may happen or should happen. This is a sector that is happening based on a large country, attractive demographics, ability and willingness to pay.
And we're seeing a lot of interest in Asia, but for opportunistic returns, for sure, north of 20% private equity style returns in the infrastructure space, not for the core yield strategies. And we're seeing a lot of interest in the US. The shale gas phenomena in the US is creating huge need and opportunity.
So what infrastructure is all about, and at least that's the way we look at infrastructure, it's this ability to generate cash yield over a long period of time. It's not much about capital appreciation, it's very much about the ability of these assets to generate cash yield.
I mean, I think clearly, utilities continue to deleverage. There's incredible opportunities to sort of work with these corporate orphans that are being spun out or non-core businesses. I mean, these are clear creation opportunities. I think, value creation, a lot of people say, it has to occur after you own the asset, but the reality is actually a lot of the time it's about structuring the entry correctly in order to optimize your performance whilst owning the asset and also in exiting the asset.
The big problem is solving the debt, but I sense in talking to governments, in talking to providers of capital, LPs in the equity space and long-term debt providers, that there is a willingness and a desire to get there.
I think one of the main challenges in the space as a whole is assessing managers with shorter track records and very few clean exits. So because it's a developing space and a developing sector, I think that's one of the main challenges going forward.
I think the biggest challenges are that really the human resource capacity, the expertise and experience that's required to acquire and manage these assets isn't growing as quickly as the capital that's accumulating to invest in the sector.
Do you think there will be more managers coming in the future, or are the barriers to entry too high?
In order to create the firm which will be credible and able to raise third-party capital, it takes quite a lot, so you cannot just do it overnight, put a plate on your door, I have an infrastructure product, give me the money. No, it no longer works like that.
There's some pressure for long-term financing, and it's sometimes hard to secure long-term financing in the current environment. So you need to find alternative ways to finance these assets. Finally, it's probably about competition, because most of these assets are visible assets, and therefore, if you're the seller, you want to organize some sort of competition to get the best price out of your asset. So you go for auction processes. And so there will always be competition on one asset, so there will be a little bit pressure on price.
The challenges I see are that in most markets in the world right now, I don't think there has been a time of more risk around regulation, certainly in the States, Canada, and Europe. around technology, because the prices of many energy technologies are plummeting.
The role of infrastructure, the value that infrastructure creates in the economy, it's become very relevant that the momentum is not lost. So today, India is spending close to about 7-8% of its GDP on infrastructure. It needs to ramp that up to 10%. 10 years ago, it was spending about 3% of its GDP on infrastructure. So we've got to keep the momentum on.
I think the number of new investors coming to the sector and having an interest in putting money to work there is strong. Clearly, there's a lot of government policies that are focused on driving infrastructure further. So I think all the fundamentals are there.
We've got shorter dated debt, we've got higher credit margins, they're lower geared. From our perspective, we see this as a real opportunity as investors over time to come. Many might argue that this raises the face, particularly in a very politically viewed sector such as PPP, the unacceptable face of capitalism, which is a phrase that's often bandied around in the context of our industry. But to me, yes, liquidity is in shorter supply, and yes, the fundamentals around which we structure our deals need to be that much more robust in terms of the context of your credit counterparties on the public sector side, the private sector side, and the allocation of risk. But for me, it's not all doom and gloom. If you have the right quality of project with the right sponsors and they're put together well, we're finding that we can raise the requisite liquidity.
I think it's great to have a conference like this one, in particular because you have the right balance between the GP and the LP representation. It's key because some of the conferences you've got out there, it's usually all the providers, but to a lesser extent the investors. So here there's the right balance, that's one. And two, we're sort of true believers in the community.
Yeah, this is very important to get a view and an impression about what the LP base is wanting to do, or the GP think about it and what they offer in terms of investment model, in terms of fee levels, in terms of co-investment opportunities for the LPs. But also, what I found very interesting, what I've heard already today, is the development of the secondary market, which offers other opportunities for LPs to step into this asset class, not through primary investment, but also through the purchase of secondary interests, being directly into funds or into the assets themselves.
Events like this allow, first of all, any kind of information asymmetry to be bridged. A lot of people that I interact with today were not fully aware of the India infra opportunity, so in that sense they've gone back educated. For managers like us, it's very useful because it allows us to have the perspective, which was surprisingly and refreshingly almost the issues all over the world are pretty much what we are dealing with in India. So it allows us to have an appreciation of even investors, even if their focus may not be India,